Okay, and welcome back, students who are taking financial accounting. In this series of videos, we are going through the theory for Chapter 9, which is on current liabilities and long-term debt. And for this particular video, let me get there. Nope, I didn't want estimated warranties. There we go. Lease liabilities. All right. We're going to be discussing lease liabilities. So, you know, basically what's a lease? Everybody's pretty much familiar with lease. It's where somebody agrees to pay someone else for the use of something, all right? And the most common one that we can think of is a car, an automobile, where you lease a car. And this will be good as an example to separate the thinking between an operating lease and a capital lease, right? Let's say you decide to lease a car. Now, if I had a business and I had salesmen, okay, and I decided to lease a car for the salesman, that would be an operating lease because I'm using that for the operation of the business. It's an expense, all right? Just happens to be a lease, okay? But if I bought the car, if I want to buy that car, all right, and I, as an asset, okay, to myself, meaning I want to buy this car as an asset, but instead of the normal, payment options of putting money down and then making monthly payments, instead I can lease that automobile, all right, as a capital lease, and then at the end of the lease period, do whatever I need to do to pay it off in order to obtain that car as an asset. So when you're thinking about operating leases, you have to really, you have to think about whether it's being used as in the operation of the business in order to generate revenue, or you have to think about it in the terms of, am I going to own this? And in that case, that's capital. Okay, so that's really the difference between the two. Now, let's talk about operating leases first. All right. So every month you're going to make a payment on the lease. Okay. In order to make that payment on the lease, you're going to credit, and let's just use the number that's actually in the book, which is $250. And let's just say that this is still for a car. So I'm going to make a payment of $250 each and every month in order to lease that car, but I'm treating this as an operating lease. Well, since I have to make that payment, that's a credit to cash for $250, right? So what am I going to debit? Okay, I can have an account called lease expense, rent expense, whatever expense. Okay, doesn't have to have the word lease in it. Okay, I could have called that, like I said, rent expense. Right? It doesn't matter, right? Because why? It's treating that operating lease just like any other expense. Okay, and so you make the journal entry just like you were making a journal entry for as an expense, except in this case here, it ends up happening to be a lease, right? But now, what if we are buying the car, and I happen to notice in the book it's a delivery truck, all right? But I'll just use car here, all right? But they're saying that they're going to, it's for $38,000, okay? Just like buying an asset, we need to record the purchase so that it's an asset, okay? So in the textbook, they're calling it a leased delivery truck, right? So when we're actually getting the truck, or in this case, car, all right? Actually, I should have just made this. Yeah, I could have just said instead of a car, let's keep it to delivery truck. All right. All right. Delivery truck for the 38,000. Right. So we need to book the delivery truck. All right. So I'm going to debit the delivery truck. If it was a car, automobile, whatever it is, it's the asset. It's naming it the same way as if we were purchasing that asset for cash. And so we book it for 38,000. Okay. But since we have a lease on it, we don't own it. Okay. We have to credit, and we're going to end up crediting lease payable instead. Right, for the 38,000. That's how much the amount of the lease is going to be. This lease payable is, no different than a mortgage payable, a note payable, all right, a loan payable, whatever it is that shows the total amount that we actually owe on that particular asset. All right. So that's how we initially, excuse me, book the asset when we purchase it on the lease. Now, because it's, we're debiting our delivery truck, that also means that we're going to have a credit accumulated depreciation for the delivery truck as an asset account, all right, so that we can book the depreciation against the delivery truck, right? And every time we make a payment, all right, and let's just make the payment the same $250. Okay. Well, when we make that payment, we're going to credit our cash for the $250. But instead, when we debit, okay, we're offsetting our lease payable here. Okay. So we have to debit our lease payable account for the $250. And so that's our entry. And of course that offsets this. So this, every time we make a payment, that's going to reduce our payable until it actually gets down to a balance of 0. Okay. And so that's all there really is to lease liabilities. Nothing more than that. The big difference is, when we have a lease, we're asking ourselves, which one is it? Is it going to be for the use of the business, all right, in order to generate revenue? In that case, every time we make the payment, we're making it just as if it was any other journal entry for an expense. When we're buying that, when we're leasing an asset in order to be able to own it, which is the capital lease, right? We have to make the entry to book the asset itself, right? And that goes against the lease payable. And then as we make the additional journal entries, all right, for the payments, they offset that lease payable so that it ends up being 0. Very, very simple. It's not anything big here. The big difference is in determining whether it's an operating lease or a capital lease. Okay, but if you in the spirit of associating, something so that it's easier to learn, all right, if it's, you associate, the normal operation of the business, well, rent expense, well, that's, if I'm it's for the operation of the business, it acts just like any other journal entry for the operation of the business as an expense. And for a capital lease, just think about how you would book your, when you were buying an asset for cash and you have the associated accumulated depreciation. Okay. And if you were, going to make payments on it, well, then you'd have the other side of that entry would be the liability account. In this case here, it's called lease payable. All right. So that's it. And only one more video to go, and that'll be on focus and decision making in the next video. And if you didn't understand something here, go ahead and pause it again, pause the video, watch it again. If you still don't understand something, feel free to telephone and speak with an instructor.